Hey everybody, this is Dan back with another Mortgage Explainer, and today's topic I think is so important for anybody considering purchasing a house within the next 1 to 2 years to understand, and I'm talking about the buy down. I've had some clients recently have a lot of success using the buy down with negotiating and getting a new home that they're purchasing right now, and with the market being what it is, there's even more opportunity right now than there's been in a long time to take advantage of a buy down. So join me in reviewing this information together. We're going to be talking about what a buy down is, the different types of buy downs. We can see the common ones are the 3, 2, 1, the 2, 1, the 1, 1, and the 1, 0. So what are those? We're going to talk about that. How to calculate the buy downs, and then also why is it a great time to consider purchasing a home in today's market, and especially with using the buy downs. So we're going to cover all that in this video. First off, what is the buy down? So right here, buy down is a mortgage financing technique, which typically the buyer attempts to obtain a lower interest rate on their mortgage within the first 1, 2, or 3 years of the mortgage. It can still be used with a 30-year mortgage. You do have to check with the lenders that you are working with to make sure that they do have the buy downs available. But I've personally helped clients use the buy down with conventional mortgages, FHA, and VA loans. So it can be available on most programs where you're purchasing a house and using a 30-year fixed rate mortgage. So check with your lenders to make sure that they do have that available based on your program and the lender you're using. So it is accomplished by getting a credit from the seller. So you do have to have a little bit of cooperation with the seller, and that's why in this market where it's shifted a little bit in our local market here, and I've talked with a lot of realtors throughout the state, and they've been saying the same thing, is that, yeah, there's still not too much inventory available, but the homes that are on the market have been sitting a little bit longer, meaning that there could be room for some negotiations. And so, yes, of course, you can negotiate the purchase price of the home, but included in the purchase price negotiations, you can ask for things like seller credits to cover not only closing costs, but prepaids for things like prepaid interest, which is how the buy down works. So you can get a seller credit if you write it into the offer. The seller agrees to give you a certain amount in seller credits, and that's used to paying upfront interest for the first 1, 2, or 3 years of your loan to help keep your mortgage payments lower in the beginning parts of your loan. Okay, so of course the benefit is your monthly mortgage payments are going to be lower during those first 1, 2, or 3 year periods, depending on the buy down option and the seller credit that you're able to get. Now, if the loan is paid off before your buy down period is over, so let's say somebody does a 2-to-1 buy down, it means it's for the first 2 years. We'll look at that in just a minute. But let's say you do a 2-year buy down, and after year 1, mortgage rates take a big drop. Let's hope so, right? So if mortgage rates drop by 2% next year, and you still have a year left of your buy down where you paid some early interest, do not worry. If you refinance that loan, your interest that you prepaid but have not used will go towards reducing your payoff amount that's remaining on your current mortgage. So there's no prepayment penalty. You can still refinance your loan at any time, and you never lose this early buy down money or prepaid interest money, even if you do refinance early if the opportunity arises. So that's pretty awesome. And again, could be available on any 30-year fixed rate mortgages where you're buying a principal residence. Check with your lender. So now we're going to be talking about the most common types of buy downs. We can see here we've got the 3-2-1, the 2-1, the 1-1, and the 1-0. So I'm going to explain how each of these work and show you some examples here in a minute. And on some of these examples that I first use, we're going to assume that a client's purchasing a house. It's a 30-year fixed rate mortgage. And let's just use an interest rate of 7.5% for this example. I am not advertising rates. To get an actual rate quote, you have to fill out an application and actually apply for a rate quote. So I'm not advertising any rates. It's just for the purposes of this example. So let's first look at assuming that, keep that in mind, if the interest rate on your 30-year fixed mortgage is 7.5%, what this means is during the first year, your payments are going to be based on an interest rate that is 3% lower than your actual rate. So your payments will be based on an interest rate of 4.5%. The second number here is how much lower your interest rate is for year number 2 that your payments are based on. So for year number 2, your mortgage payments are based on a rate that's 2% lower than your actual rate. So again, if your rate's 7.5%, then your payments are based on a rate of 5.5%. And then for the 3, 2, 1 buy down, there is this third number, and that's for year number 3. And so on that third year, if you have not refinanced or paid off your original loan, your payments will be based on a rate of 6.5%, which is 1% lower than your actual rate. So for the 2 to 1 buy down, again, this is always showing you what happens that first year in the first number. So this is the most common, the 2 to 1 buy down, where for that first year, your payments are based on a rate 2% lower than your actual rate. And for the second year, they're based on a rate that's 1% lower than your actual rate. All right, so follow me along. It's going to be a little bit better. Let's get into some examples here. For this first example, we're going to be using the 2 to 1 buy down. Now, this is probably the most common of the buy downs, at least with my experience, and that most people talk about the most. So again, we're using a 30-year fixed rate loan. We're going to use an estimated loan amount of $285,000 and just a sample interest rate of 7.5%. So a 30-year fixed rate conventional example here, okay? Now, for year number 1, you can see even though your end rate's 7.5%, that first year, your payments are based on an interest rate of 5.5%, meaning your principal and interest portion of your payments are $16.77, which is over $300 less compared to if you were not using the buy down and getting just the regular mortgage without the buy down at that interest rate. So $374 lower your payments are. Now that comes out to a cost of $4,496.05. That's the difference between the 2% that your payments are lower by. And then for the second year, again, the 2 to 1 buy down, meaning year number 2, your interest rate is lower by 1%. So then your interest rate is based on 6.5%, or your payments are based on 6.5% as the rate. Your payment is then increased compared to the first year. So $1,800 is that principal and interest payment. And the monthly savings for year number 2 is $191.44. And annually that comes out to that cost of $2,297.29. Let me just make sure, so you guys can see that. So the total cost right here, $6,793.34. So that's the amount you would have to get as a seller credit or a seller concession in order to get a 2 to 1 buy down using that loan amount and that interest rate for the 2 to 1. Okay. Now we're going to go through another example here as well. And of course, you can see by year 3, then your rate goes to the 7.5%, which that's the end and the true fixed rate. If you get a fixed rate mortgage, that'll never go up or down after these first couple years. On the next example, I'm showing the 1 to 1. So maybe you can't quite get as much money from the sellers as you need for the 2 to 1. Maybe you can get, close to a $5,000 seller credit. You can still look to do a 1 to 1 in this same situation. So again, we still see it's a 30-year mortgage, loan amount $285,000. We're basing it off a rate of 7.5%. And for the first 2 years, because it's 1 to 1, for the first year and second year, your interest rate is 1% lower than your actual rate. So then your payments are $1,800 and $1,800, again, respectively, for the first 2 years in your principal and interest. And that cost is $4,594.59. You're saving out of pocket per month in your payments $191.44. So pretty cool. And again, we can think that in the next couple years, if people believe that rates are coming down, which I do believe that could be very possible. I cannot promise anything to anybody. We still have to be comfortable with where these end payments may end up, with where it would be once after your buy down period is over. and you have your actual end rate there too, you have to be comfortable with that payment because that is a real possibility. But a lot of people are hoping that, hey, let's get a good deal on a house right now, take advantage of these buy downs to help keep our payments lower, and hopefully rates come down in the next couple of years and we can refinance and hopefully get a lower end rate at that time, knowing that you're still going to be conscious of what your end payment will be, that you can still handle that if you don't refinance right after that buy down period is up or before the buy down period ends. So I hope you're all getting the idea. Let's go through another one together. The 1-0 buy down shows if your interest rate is reduced by 1% for the first year, and it's only that 1 year because it's 0% the second year, so it's at your actual rate. So again, using a loan amount of $285,000, a rate of 7.5%. And so you can see here, during that first year, your payments are based on a rate of 6.5%. That's a cost of $2,297.29. So again, if you can maybe only get $2,500 in lender credit or from seller credits from the seller of the property, you can still look to do a 1 year buy down and help lower your mortgage payments for that first year. So pretty cool. Now I'm going to switch up the example here really quick. Last one, we're going to go through a 3-2-1 buy down. What I changed on here, it's still a 30-year mortgage. Loan amount I did change, so I'm going to assume a $175,000 loan amount just because I want to show everybody that, these costs and the savings change based on your loan amount. And I even just adjusted the interest rate here to 7.25% as the end rate, just to switch up our examples. So yeah, you can still see everything here. So again, that first year, your rate is based on 4.25%, 3% lower than your actual rate for that first year. And your payments are $332 less than if you were not using the buy down. And again, for the second year, it goes to 5.25%, third year, 6.25%, until that fourth year at 7.25%. I think you get the idea, right? So the total cost, if you add up the cost that those 3 years would take to buy down all of that, would be $8,121.50. So that's the minimum amount you'd have to get as a seller concession or seller credit in order to get this buy down. So in my opinion, right, this is a really good opportunity for some clients to consider purchasing a house if you can still know that you can handle what the end payment would be, and also that you do believe that, hey, maybe these rates do come down. If that happens, then it's expected there's a lot more buyers that could come back into the market. There's certainly people right now waiting that don't own a property, that once these rates do come back down a little bit, they're going to feel more comfortable with entering the market. They're going to create more demand for homes. And yes, there's even going to be people that own homes right now that have low rates that are either going to list their property and then look to purchase a new house once rates get a little bit more reasonable. And they're going to offset it a little bit with maybe having a house to sell. But what if some of those people have money for a down payment and they still don't want to pay off their other house with the lower rate? They might hang on to that property, rent it to family or become a landlord for the first time. And I still think that we're going to have low inventory going into the future. Again, this is just my thoughts. You can give me your opinions on what you see happening in the market here too. But if these rates do come down, I think that's going to create more demand. I think home values are just going to continue to increase here over the next 2, 5, 10 years. And this could be a really good opportunity right now to get a house at a good price, take advantage of the buy down, use this as an opportunity to help keep your payments lower for the first, 1, 2, or 3 years of owning the home. Hope that rates do come down. We can help you refinance if and when the mortgage rates do come down. And again, you might be able to do that and buy a house cheaper today compared to if you do wait until these mortgage rates come down. So, that's my opinion on everything right now. If you have any other questions, please do reach out to me anytime. Hopefully everything with the buy downs were clear enough for everyone. I'm happy to go through any again and put together more exact situations for different scenarios for clients too. So you can always reach out to me here. Thank you all for stopping by again. I do appreciate you watching, and I hope you have a great day.